Hello, my friends. My name is Peter Borovic. I've been a trader for years. I've traded stocks, equity derivatives, and options. So I know a thing or two about stock markets. And today I would like to talk to you what happened on August 24th, 2015, as the media refers to the Black Monday. Black Monday, huh? October 19th and October 29th, the Black Tuesday and the Black Monday, everybody forgot about. Now there's a new Black Monday. Are you kidding me? Every single day the stock market is down 2 to 3%. You're gonna call it a Black Monday? Come on, guys. So today the stock market closed 3% down. What about Friday? Nobody cared about Friday? The stock market fell also 3% on a Friday, but nobody called it Black Friday. People called it a Black Monday on the August 24th. And guess what? I don't know the answer to the question why exactly the stock market fell, but I know a couple of insights based on the numbers. And I'm going to be analyzing those numbers in the next couple of minutes in Excel. Okay, guys, tune in because I gotta show you some real stuff.
It's August 24th, 2015, and this is how the S&P 500 looks like today. The stock market is down 3.94%, almost 4% on the day. But let's take one step back. If you are even somewhat familiar with the technical analysis, does this chart look bullish to you? Really? I mean, this is the chart as of Friday, August 21st. I don't see any dojis there. For those of you who are not familiar with the technical analysis, doji is a pattern highlighted in blue. It usually indicates the end of the bearish trend. Let's take a look again. No doji, no slowdown in plummeting of the S&P 500 index. So why everybody is so surprised on a Monday? I never got so many calls than today asking me what happened to the stock market. I got a call from US, UK, Australia, Argentina, Russia, China, India, and lastly, my close friend from Brazil asked me, what the is going on? And that stupid hashtag Black Monday on Twitter that got to the top. I mean, on a Friday, S&P 500 fell down 3%, but nobody seemed to care. My phone was silent, although I had many more meetings set up on a Friday. I just don't buy the fact that something significant happened on the 24th. China, oil, Russian sanctions, I just don't buy that. The message that I want to convey to you is, don't panic. Call me crazy, I don't care. Let me just give you my analysis. Last month, the S&P 500 had 7 days when it had a maximum loss of more than 1%. Max loss is equal to the low on the day over previous close minus 1. And we included August 24, 2015 in that data set. Now, a month before that, the S&P 500 index had 4 days when it had a maximum loss of more than 1%, where the max loss is again the low on the day over the previous close minus 1. Now, what about 2 months before that? S&P 500 had only 2 days when it had a maximum loss of more than 1%. Reasons? Well, clearly the volatility has increased lately, and the reasons include China, Russia, crude oil, in short, high frequency trading, ha ha ha. But again, the volatility has been increasing gradually as I just showed you, so it won't make much sense to close positions now after the volatility already spiked up. Don't panic now. If anything, you should have panicked last week when volatility was just about to spike up, but not now. But what if volatility keeps going up? Well, that leads me to my second point. If you read my book or watched my video course, you would have known the 2 trading rules. First off, sell in May and go away, and secondly, the summertime blues. I statistically show that summertime is just not good for holding positions. The market usually shows higher levels of volatility in the summertime and often experiences sideways to bearish trend in the summer. And all that bad stuff is done by the end of the summer. Again, don't panic now. If anything, you should have closed your positions 3 months earlier, but not now when you have just a couple of weeks left. Couple of weeks until when? Well, if you read my book or watched my video course, you would have known. The trading adage, sell in May and go away, don't come back until St. Ledger Day. The rule called the St. Ledger Day rally, based on which if you buy on St. Ledger Day and hold until the end of December, if you actually follow that rule, you should expect the average historical return of 3.9% over the course of 4 months at a historical hit ratio of 73.9%. It's all historical and might not turn to be positive, but the odds are there. By the way, St. Ledger Day will take place on September 12th, 2015, just a couple of weeks from now. Again, don't panic now. Maybe it's better to wait a couple of weeks. Now, as you calm down a little bit, what really happened? I have a theory based on my research. And of course, I conducted that research quickly in Excel. So, the S&P 500 fell almost 4%. But the S&P 500 is the average of 500 stocks. It means that some stocks fell below the average, while other stocks didn't fall as much. Let's take a look at all the members of the S&P 500 index. Right now, although it's S&P 500, right now it's really 502 stocks in it. True, 460 out of 502 dropped 2% or lower on a Monday, but 32 dropped less than 2% or even went up. I believe the stocks that held up on such a tough day were the ones bought by institutional investors. Hence conclusion, amid tough sell-off, these stocks might have substantial valuation for future growth. And here's the list of these stocks. You can find 32 potential strong names that actually went up on the day when the majority of the stock universe fell 2% or lower. We made it easier for you since you can find the link to this file in the video description below. Enough of stocks, let's talk about you. You know you are obviously really serious about making money on the stock market and getting the highest returns with lowest amount of risk possible, and I just want to take some time to acknowledge you for that. Most people never take the time to educate themselves and resolve their problems the way you have. You are online, you're watching this, and you really have the commitment and determination to do this now. That's why you are perfect for the Trading Ninja Bootcamp. Trading Ninja Bootcamp is the trading designed specifically for people like you who want to go ahead and start trading and investing as soon as possible, because it teaches you the right mindset to become a trading ninja, rationale behind trading signals, and ways to identify correct entry and exit points. If you like what you heard, you will find my course Trading Ninja Bootcamp very helpful. The offer to get this course for free is active until September 25th, 2015. Click the big green button you see on the screen and you will be redirected to our page. Fill out the form and you'll get immediate free access to my Trading Ninja Bootcamp. Thank you very much and have profitable trading.